export revenues as compared to the normal share of about 8%. This is also visible in segment financials. During Q2FY21, the specialty chemical segment reported consolidated segment revenue of 1109 crores as compared to rupees 895 crores in Q2FY20 and annual revenue of rupees 3865 crores for FY20. The consolidated EBIT for segment was rupees 190 crores for Q2FY21, thereby generating EBIT margin of 17% as compared to the EBIT of rupees 214 crores and EBIT margin of 24% for Q2FY20. While the annual EBIT for rupees 814 crore resulted into an annual EBIT margin of 21% for FY20. I would also like to highlight that YOY comparison of the margins may not be a right method to see the Q2 performance. As you will recollect, during Q2 last year, we had faced some raw material supply limitations, specifically nitric acid, that had resulted the volume for some of our products to be lower than planned. As a result of the shortage of this food stock, the price of downstream products with high demand had temporarily moved up, resulting into higher margins in that quarter. Now for the Q2 production update, there has been a higher scale in following reduction in lockdown and volumes have been expanding. Production for nitrochlorobenzene was about 17,830 metric tons per Q2 as compared to 13,945 metric tons a year back. Similarly, for hydrogenated product, we achieved production of about 3,040 metric tons compared to 2,003 metric tons per month last year. On the nitrotoluene front, the production in Q2 was about 4,120 metric tons, which was about 1,363 metric tons in the same quarter last year. At present, as I said earlier, we are operating at about 80-90% capacity utilization across locations and expect improvement in operating and financial performance of the current financial year. Moving to the pharma segment, during Q2FY21, the pharma segment reported consolidated segment revenue of 222 crores as compared to 182 crores for Q2FY20 and annual revenue of rupees 756 crores for FY20. The consolidated EBIT for the segment was rupees 57 crores for Q2FY21, thereby generating an EBIT margin of 26% as compared to the EBIT of rupees 34 crores for Q2FY20 and EBIT margin of 19%. While the annual EBIT of rupees 137 crore resulted into EBIT margin of 18% for FY20. Our pharma business continues to grow and see operating leverage based on the increasing volumes as demand remains intact. Pharma revenue growth was being driven by increasing contribution from regulated markets and value-added products. We delivered record profits in segment and margins expanded to over 25%. Continued growth and operating leverage likely to be maintained in the near term. Further, we are witnessing a structural margin expansion for Indian manufactured API and intermediates along with a strong long-term demand, which will drive growth for this segment in coming years. Ongoing expansion of API and intermediate facilities is expected to be progressively commercialized in next 2-3 quarters, which will allow the momentum to sustain. Going forward, capacity expansion will drive deeper penetration in therapies such as anti-hypertensive, cardiovascular, oncology, corticosteroid, etc. We also have a strong pipeline of approvals and visibility to maintain growth. We have been witnessing various growth opportunities flowing into for Indian pharma manufacturing from a global standpoint, which is also well supported by the government's Atmanirbhar initiative. With this kind of opportunity, we are working on a bucket list of new pharma products which we would like to expand into in the future. With this rationale, we have acquired a large parcel of land in Gujarat. We are at the drawing board stage on these opportunities and we'll share more details as we move forward. To summarize the Q2 performance, gross income from operation expanded by 23.5%. Profit margins were impacted due to the factors discussed earlier, apart from higher depreciation on new facilities and lower other income. Also want to highlight for the quarter, we have recognized revenue of around $5 million during Q2, just as we did in Q1, being a shortfall fee eligible as per the terms of the long-term contract discussed previously. Overall, we are satisfied with Q2 performance and look forward to operational improvements and higher performance during the course of the second half. We continue with our guidance of full year profits to be flattish and expect significant growth momentum from FY22 onwards. Our focus on expanding value-added product chemistry and value chains in the portfolio has allowed us to emerge as a leading global partner to growing list of innovator companies. Also, with a view to enhancing long-term prospects of the business, we have been investing in organizational competency, including R&D initiative, SHG excellence, talent acquisition, and greater process orientation, benchmarking ourselves with the best-in-class global practices. Added to this positives is India's rapid response as a leading supplier of chemical intermediates are likely to increase the country's share in the global market. Aarti Industries is well positioned to benefit from these trends. With that, I conclude my opening comments. We'll open the floor for the Q&A session. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets for asking a question. We will wait for a moment while the question queue assembles. To ask a question, please press star one. We have a first question from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Yeah, thanks for the opportunity and congrats on a good set of numbers on a sequential basis. So the first question is the land that we have purchased. So how much have we paid? What is the area? And most importantly, given that we are having a capex plan of almost 1,000 crores per year, so how much land is available from future expansion perspective? So how many years would this land be sufficient? Thank you.
Yes, Chetan, you can brief about the new land.
Yeah, I can take it up. So we have procured a land parcel in Gujarat, and the total parcel size is close to 105 acre of land, and it is in the Dahej belt. So, and it will be utilized for pharma and chemical. So we plan to utilize larger parcel for pharma and a parcel for chemical as well from this.
Yeah.
So in addition to that, we have a 75 acre parcel in Jagadia currently available. Also.
So given the current expansion spree, how many years would this land be available? I mean, until it gets exhausted and we will have to procure new land parcels.
Yeah, with the 75 acre in Jagadia and some more in new location, at least for next 3 to 4 years, I think should be sufficient for the project. And for pharma, maybe even longer period, but for chemical, about 3 to 4 years, I think.
Okay, thanks. The second question is, could you just give us the timelines for the commissioning of long-term projects? Has there been any delay or they are on track? Both the 10,000 crores and the $125 million project. Thank you.
Yeah, the first one will be commissioned in Q4, and the second one, 10,000 crore one, is expected to be in first half of next financial year.
So earlier, I think it was in second half of this financial year. So it is being delayed by another maybe 3 to 6 months. Is that correct?
Yeah, there is some delay in second project because of some equipment related issues.
Sure. Thanks a lot and best of luck and Diwali wishes, sir.
Thank you. We have next question from the line of Sudarshan Padmanabhan from Sundaram Mutual Fund. Please go ahead.
Yeah, thank you for taking my question. So my question is, specifically on specialty chemicals and margins, which you had given a brief, description on, specifically doing work on the discovery thing for the COVID part. What I would like to understand is on the specialty side, when you talk about recovery happening on the non-essential part, how much of the recovery is basically happened versus pre-COVID? And second is, should the margins trend back to normal, or, is this something that we would continue to pursue?
Domestic demand for discretionary is almost now in a Q3 is reaching to pre-COVID levels. Whereas export, it is going to still take like the next 2-3 quarters. So going forward now, we will see the improvement in margins in discretionary segment.
Sure. So the product mix would basically go back to where it was, probably, from the second quarter is what you're alluding to.
Yeah. Then also the market, will go to more towards a more of a regular market, which will have a higher margin also. So progressively the margins will increase.
Sure, sir. And sir, from a longer term perspective, with the long term contracts that are available, and second is, even if I go through the annual report, over the years, we have basically been working on, more complex chemistry, moving up the value chain. So from where we are today, when we are talking about, say, in FY23, in 2 to 3 years, where we'll be utilizing the land fully, what is the kind of margins and ROCs which one can expect, given that we are definitely moving up the value chain and investing in more, complex chemistry?
So progressively, we'll see that margin as well as ROC will be improving. But ROC generally will also depend on the capacity utilization at that particular time.
Sure. And specifically with respect to this Atmanirbhar, given that this has basically been announced, earlier this year, when do we start seeing the benefits, as far as our business is concerned, from our clients?
Yeah, some of the pharma API products which are announced in Atmanirbhar, we also make raw material for that, so that will come in. And we expect some similar scheme for chemical also. So that will also directly and indirectly will benefit us. So in general, I think overall we will see our intermediate demand increasing in India.
Sure. So thanks a lot. I'll join back to you.
Thank you. We have next question from the line of Naushad Chaudhary from Systematics Group. Please go ahead.
Hi, thanks for the opportunity. Hope I'm audible.
Yes, you are, sir. Please go ahead.
Yeah. First question on the inventory liquidation part, sir. Can you help us understand how much inventory have you liquidated in this quarter, and which all products were there in that inventory, and how much it had impacted on a margin, if you can quantify?
So, hi, this is Chetan here. So there is, it's not a single product inventory. There are multiple products on the discretionary side, which has been there. So as you would have noted that we've been operating initially in the start of the year at 50% and gradually ramping up to 80%. On the discretionary side, the demand was being significantly lower from the regular market, and there was an inventory which was being piled up. If you note the Q1 numbers, the inventories to the extent of 46 crores was there higher as compared to the Q4 numbers. So those are the kind of inventories which we have looked to clear out and look at supplying to the non-regular markets.
Okay, so it was just a 46 crore rupees of
No.
inventory.
It's not just at 46 crore. There is a much more. So that's the impact on a quarter-on-quarter basis. But there were other inventories as well. So the value specifically, if you want to look at it, I don't have that specific number right now. But I'm just giving a perspective that there was a higher inventory pile-up which was happening, and we look at deploying that inventory and converting that to cash by way of supplying that to the non-regular market. It also helps us in terms of adding an additional market and some more diversification on overall, which probably could help on a long run basis.
Okay, would you be able to quantify in terms of margin how much it impacted on EBITDA?
It will be difficult for me to put a specific number to that at this stage.
No problem, sir. Secondly, is this a part of our regular business, or was this just something one-off which we have, witnessed in?
In general, if there are additional capacity or material available, you can try to send it to a non-regular market. So it will be as per the need basis generally.
it's a part of our business, and we can see these kind of things in coming years as well if there is not much demand of.
Yeah. Yes. We can divert that to the non-regular market.
Okay. Secondly, sir, we have mentioned we have started. We have partly commissioned a chlorination business, which initially had a 65,000 ton per annum capacity. So, how much capacity we have started, and what is the rationale of starting partially of this plant?
Partly is basically first phase. There are in the chlorination, the first segment is commissioned, and second part is under commissioning. So it will get fully commissioned by end of this quarter. So it is basically it is a sequential commissioning. The entire thing will get commissioned.
Okay, and how do you see the ramp up of this capacity?
Yeah, that will take at least 2-3 years. Which is a very step jump in the capacities.
Okay. And last very quick one, sir, if you can share the PDA volume number of this quarter.
Yeah, I'll share the numbers for PDA in this quarter. So the PDA volumes for the quarter was we had a monthly production of around 470 tons, which in Q1 was around 360 tons.
Okay, and correction on a nitrotoluene number, it was 4120 of in this quarter, right?
Yeah.
Okay, that's it. Thank you so much.
Thank you. We have next question from the line of Surya Patra from Phillip Capital. Please go ahead.
Yeah, thanks for the opportunity, sir. So just on the margin again, see, we have obviously, because of the product mix issue, we have seen some impact on the gross margin front, and hence the overall margin got impacted. And in the previous quarter, we had seen on the other expenses front some issue because of the higher spend relating to the COVID-related aspects. And although the gross margin was better in the previous quarter, but because of the higher COVID-related spend, it was slightly lower. My question is that, see, although we have seen, or the entire industry has witnessed a kind of marked improvement in the overall margins because of the improving spread, because of the lower or the sharp correction in the crude prices. So, contrary to that, we have not been seeing, or rather we got impacted in terms of margins over last 3 quarters since when the crude price corrected. Can you just clarify that, and what is the outlook that one should have in the second half or going ahead?
Yeah, basically I think we have told many times that for us, we are crude neutral. It's a raw material pass-through model. Actually, crude price is going down. It impacts our into inventory losses for us. So that way, lower crude or higher crude doesn't impact us as far as the margins are concerned. It is just the discretionary side, the demand is under pressure, so that is leading to the lower margins that side.
But do you think that is going to sustain for some more time, at least for this current financial year?
So progressively it will reduce. That's what I mentioned now. The domestic demand is virtually reaching to pre-COVID levels. And export also we are seeing that progressively it is increasing. So margins should quarter on quarter should go on increasing.
And generally, sir, even since we have seen improvement, sequential sharp improvement in the domestic side, so ideally that should have added to the margin expansion only, but not meaningful margin expansion sequentially that also that we are witnessing.
Yes, another expenses also increased. No, that also we had mentioned. So that has affected that margin at the EBIT level, the depreciation and fixed overheads for the new plants which has been commissioned.
Okay. So second question was on this dicamba supply contract. See, in fact, obviously it is now the contract has been cancelled, subject to followed by the development that what US court has ordered about dicamba. But now having the ready facility with us, and now they are extending that usage for another 5 years. So should not we be excited about it, because we have got adequate compensation in one hand, and we have ready facility, and there is a global business opportunity that is also visible.
Yeah, correct. Recently only the US government gave 5-year extension for all dicamba related formulations, which is a very positive sign for that industry. And we see that this will increase dicamba demand going forward. And as we had mentioned earlier also that we'll be participating in that demand, because the customer ultimately is going to buy dicamba instead of making dicamba. So we'll be tied up with the dicamba manufacturer, and also we can look at putting up some part facility for ourselves also. So that also will be deciding whether to do that also, or have only supply to the other manufacturers.
Okay.
So there's a couple of options we have, and we may have both of them or only one of them. But obviously this development is a good sign. It will increase the dicamba demand, and correspondingly we'll be able to supply our intermediates.
But this compensation is all set and decided, right, sir?
Yes.
Okay. Just last question, sir, from my side. On this polymer project, although we are maintaining our guidance that is likely to start from the fourth quarter, but here how staggered and in terms of utilization that one should really see for this project, or any since it is given the kind of current scenario, COVID uncertainties and all, so whether it will look like, or it is likely to be a kind of much staggered compared to the earlier stance, or what is your expectation in terms of starting the supplies and ramping up there? Because we have seen some supply issue in one first project, so that's why if you can give some clarity on it, that will provide more confidence.
As I mentioned in an earlier question that that commissioning will now go instead of Q4, it will go more in Q1 of next year. Some equipment delays are there. And overall I think the demand impact is also there, so customer side also pull is less. But we'll be commissioning in the next year that project.
And utilization wise in the first year would be how much that one should see, sir?
First year maybe around 50% or so.
Okay. Sure, sir. Thank you.
Thank you, sir. We have next question from the line of Sneha Talreja from Edelweiss. Please go ahead.
Hi, sir. Good evening, and thanks for the opportunity. So my question was related to specialty chemical segment. So what is their utilization right now versus last year?
No, last year Q2 was impacted. That's why you have seen the numbers also. YOY, all the numbers this quarter were higher than the last year numbers. And currently, about 80 to 90% most of the plants are running.
Which is same as what we ended the Q1 with.
Yeah, Q1 was more, first month was only 50% and we had reached around 80% by May, June.
Okay. So my second question was more pertaining to the pharma margins. So likewise, you mentioned that, specialty margins will see an inch up once your discretionary, spends, product sales starts again. Pharma margins have, almost touched the peak of what you've ever achieved. So is there any temporary element or, one-off element, or you see this margin sustaining because of the product mix and, rupee depreciation here?
Yeah, I think pharma margin overall have moved to a reasonable healthy level. And, we have been fully utilizing our current capacity, and of course, the new expansion is going to come in. So, in terms of EBIT percentages, this is a good number to be. Anything about 25 is a good number. And overall, there will be growth in terms of QOQ and YOY because of the new capacity addition that will come in the years. Next question.
Got that, sir. Thanks a lot, sir.
Thank you. We have next question from the line of Chetan Thakkar from ASK Investment Managers. Please go ahead.
Good evening, sir. Sir, just had two questions. One was, what is the capacity that has been commissioned for chlorination already in this phase, and the PDA volume, if you could share that?
No, we have just started the monochlorination step. The dichlorination step has not yet started. So that's why it's a part commissioning in that sense.
Yeah. So just to add on that, PDA volumes for the quarter is 470 tons per month.
Okay. Thank you so much for this. All the best. And wishes for the festival. Happy Diwali to everyone.
Thank you.
Thank you, sir. We have next question from the line of Keshav Lahoti from Angel Broking. Please go ahead.
Thanks for the opportunity. I just want to understand, as you know, there's a China story that's playing out for the entire chemical industry. So Aarti being one of the beneficiary of it. How should we look at, export share as a percentage of revenue to going forward?
Yeah, actually, because now the overall manufacturing in India is increasing. So we are seeing a lot of good traction of material being sold within India itself. I think this export in the range of about 40 to 50% level might remain for us. And we might have more sales in India, which will be then indirectly exported by our customers. Like some of the products which we sell it in India, 100% it is used for export.
Okay, understood. So, in a way, we are seeing, traction, like our export pie is increasing. That is what your sense is?
Yeah, as a country, export pie will increase, and then part of that, we will be supplying to the people who will be ultimately making some agrochemical molecules, some or advanced intermediate or pharmaceutical, which will get exported. So some of the agro intermediate which we sell it in India, the finished molecules is not at all consumed in India. They get 100% exported out of India.
Okay. Understood. Okay. I just need an update on contract one, which got, cancelled. So possibly we might not be supplying to the concerned party. So for that product, are we manufacturing product and supplying in the domestic or international market?
No, actually we will be commissioning that second phase of that project only in this Q4 of this year.
Okay. Thank you. That's it from my side.
Thank you. We have next question from the line of Archit Joshi from Dolat Capital. Please go ahead.
Hi, sir. Good evening, and thanks for the opportunity. Sir, I just remembering from the last call, we had sort of divided the $20 million bullet payment from the cancellation of the contract in the 4 quarters, and I think we had accrued approximately $5 million in the first quarter. So just want a clarification if we have done the same this time around, this quarter.
Yes.
Right, sir. Just an extension to that, I think we were expecting this stream of cash in our balance sheet by the end of this year. Are we still on track in terms of receiving that amount of money, or is there any delays in getting that?
No, it's as per the contract term, so there's no change which is asked on that.
Right, sir. And so this $5 million, approximately 37 odd crore rupees, this should directly flow into our EBITDA or PBT. So considering that also, sir, I mean, a lot of questions have been asked earlier on the margins side earlier. So if I just remove that from our sales and EBITDA, our margin comes even lower. So just wanted to understand if there's been any, other than the discretionary items that we have been selling in the exports market, is there any new normal that we are seeing in terms of the tier A and tier B buckets that we have in terms of the commodity products that we sell? Have we seen any correction which could be a new normal sort of a thing in terms of realization?
No, other than the discretionary products, there is no impact on margin side on whether products which are going in agro, pharma or FMCG.
And other than that, you also need to just consider that there are certain expenses and costs which are being charged on a fixed cost basis related to that contract. So it's not that the entire 5 million directly goes to the bottom line. There is an expense charge which is also coming in towards that.
Sure, sir. Thanks for that. One last question, sir. I just got a little confused when you were speaking of the first contract. You said that the second phase will be commissioned in the fourth quarter. What is this phase exactly? Have you found any alternative route of applications from that plant that we had partly capitalized, I think, in FY20 or the first quarter?
So that product has other usage also, and we can sell to others also. And as we discussed earlier, that product dicamba is going to be manufactured and by various companies, and we'll be selling those intermediates to them.
Right, sir. Okay, sure, sir. Thanks for that, sir. That's it from my side.
Thank you. We have next question from the line of Rohit Sinha from Emkay Global. Please go ahead.
Yeah, thank you for taking my question, sir. Am I audible?
Yeah.
Yeah. So most of my questions are already answered. Just wanted to know your thoughts on, as we have recently know that Bodal is also looking to come into this benzene derivative side. So are they going to compete in some of our products line, or how we are seeing that into our competition?
No, we have yet to see. I think we have some press notice comes. We will not seen, but because of this increase in PNCP demand is substantially expected to increase. Maybe that can be the trigger. I don't know what is the trigger for that.
Okay. So, yeah, that's it from my side.
Thank you, sir. We have next question from the line of Naushad Chaudhary from Systematics Group. Please go ahead.
Hi, thanks for the opportunity again, sir. Again, a more clarification on the inventory and margin part, sir. If I look at the balance sheet, there is hardly any change in terms of inventory if I compare it with March 20. So just wanted to understand, is there still inventory pending which is expected to be liquidated in this or coming quarter, or is there any new product inventory we are building up?
This inventory is in a routine course. Actually, the more building was happening on the first quarter when we realized that the regular market is not picking up the material. So that's why we sold that into a non-regular market. So now we are not building the inventory. We will see, whatever we are producing, we'll sell it to a regular market or non-regular market.
So why I'm asking, sir, if I connect it with the margins, sir, so we have only two reasons for the margin drop in this quarter. First one is inventory. Second one is the chlorination plant which we have started, which is also a 50%. So if I look at the positive side, we had a substantial volume growth, around 30-35% in our key product volume growth. We had a very good utilization, plus 35 to 40 crore rupees we have recognized from long-term contract, plus nitrotoluene have recovered, which had a issue last year because of the raw material. and still we have a drop of 700 bits in the chemical margin. So I was not able to understand this exactly what has dragged this margin.
So this new projects what has been commissioned, there will be fixed cost because of that. There is a higher increase in depreciation. Then some COVID-related expenses are also there. So those things have combined, and the discretionary because there is a pressure on the margins. So this non-regular market, the margins are still lower. So that is a broader price pressure is there in discretionary segment. And if you're putting into non-regular market, the impact is still more. So that is the reason that margins are impacted. And going forward, quarter on quarter, I think that margins should go on improving.
Okay, from the next quarter onward, can we see it is going towards 20 or 22, which we used to guide earlier?
So it will be progressively increasing. Both the utilization will increase as well as the market spread also will get better.
Okay.
Another point just to add is that if you look at the inventory days in the overall basis, the inventory days has fallen off by more than 10%. So that probably you could just do some calculations on that. It might just give you some reflection.
Okay, I'll do it. Thank you so much for the clarification and all the best. Thank you.
Thank you, sir. We have next question from the line of Harsh Bhatia from Emkay Global. Please go ahead.
Yeah, sir. Thank you for the opportunity. Just a clarification on this dicamba extension. If we already expanding the capacity for other uses, even if we go ahead for the dicamba to supply the intermediate as a dicamba usage, it would be more export oriented or it would be more related to the domestic market? Like in what scenario could we see more export offtake? And if yes, would this be more towards US market or Europe market?
Basically, now we will be supplying to the manufacturer of dicamba who are either in India or China. So then they will make the product and sell either in US, Latin America or wherever.
Okay. So the supply would be towards domestic market or Chinese market. Okay.
Yeah, so we will be making intermediate. The major market for dicamba is more on US and Latin America.
Okay, as opposed to Europe.
Yes.
And in your opening remarks, just a clarification, you had mentioned that significant quantities were in Q2 were taken to China, almost 20%, as opposed to 8% that is in normal case. Am I right, or this is any clarification on that?
Yeah, that percentage of export had increased from China from normally about 8% to 20% of our export has gone to China.
Right. So any more color on this, like as to what reason, any specific product, or could this be the new normal going forward?
Yeah, that's what the point was. The discretionary spend, our regular market, the demand was impacted. So then after accumulation of inventory in the first quarter, then we decided to go for newer market and identified customers in China. And we have supplied to them. So this will be good for us on a longer term basis also. So time to time, we'll be able to tap that market as and when required. We have some regular market for some of our products. We have a regular market in China. And some of the products which will be, which will of little less margin might become, more of a on-off kind of a market.
Okay, so going forward, we can expect 15 to 20% range for the Chinese market. Right. That's it from my end. Thank you so much.
Thank you, sir. We have next question from the line of Nitin Agarwal from IDFC Securities. Please go ahead.
Thank you.
Sir, please ask your question. Your line is unmuted.
Hello. Yeah, sorry. So thanks for taking my question. Sir, on the pharma business, you talked about a lot of the newer opportunities coming into play, and you sort of going in for a much larger capex expansion. Look, what is the nature of some of these opportunities that you are seeing, which is different than the business that you were doing earlier?
Yeah, we are going to concentrate on the intermediate and the CDMO part of the intermediate business going forward. So apart from the API business, so that is what is the area where based on our chemistry skill set and the customer base that we are approaching, we will be able to gain significant growth in this area.
And when you say CDMO, this pertains to what? This is pertaining to some innovative, some global innovators you will be working with for the intermediate?
Yes. We will be working with global innovators, and also we are also specialists in onco products. So there are a lot of other generic companies also who don't have their onco capabilities. They also apply, and they are, we are doing a lot of backward integrated work for them as well. Because any onco product which needs to be commercialized, you need to be vertical because, and they are trying to create a virtual vertical platform for them.
So, sorry, on the onco bit you mentioned, it's again the intermediates for the onco products or the full APIs for the oncology products?
Both.
So now with all of this that you sort of put together in terms of these, initiatives that you're taking on the pharma business, do we see pharma's proportion in business sort of meaningfully increasing over the next 3 to 4 years?
I think overall chemical is also going to grow significantly, and pharma will also grow. I think pharma next couple of years we anticipate again 15 to 20% top line growth. Because of the new facilities coming up, and then the large facility that we plan to build will be commissioned after that, so after a couple of years.
So on the chemical business, sir, during this COVID phase, have you seen any changes in the demand patterns? Which sort of gives you a little more positivity on your business outlook? Going forward, any meaningful changes you've seen both from an innovator demand, from a global demand as well as domestic demand perspective?
Basically discretionary demand has been impacted, whether it's in a textile or construction or automobile and all that, That is expected. There is a global demand impact. But the domestic demand has now picked up back to pre-COVID level.
And sir, on the new chemistries that we've been looking to work on, have you identified which new platforms are we looking to work on or to sort of build capabilities on going forward?
Yeah, we are planning to enter into chlorotoluene range. So that has a lot of different chemistries coming in that range.
Okay. And I'm going to squeeze in the last one, sir. Earlier we gave guidance that we should be able to compound our profits by about 20-25% on a long 3 to 5 year basis. This year essentially is a blip year. How should we look at this guidance over the next 3 years beyond that?
No, actually our guidance is 15 to 20%, not 20-25%. We will look at those guidance should not be an issue.
Okay. Thank you, sir. And best of luck.
Thank you, sir. We have next question from the line of Abhijit Akela from IIFL. Please go ahead.
Yeah. Good evening, sir. Thank you so much for taking my questions. I joined the call a bit late, so apologies in case you have already asked some of this. On the dicamba intermediate project, have we firmed up our plans, sir? Are we going ahead with some specific manufacturing capacity by end of this year?
Yeah, the plant will get commissioned this year. By end of the year, yeah.
No, so I guess Abhijit just clarify the question is in relation to setting up the dicamba facility.
No, not dicamba, our intermediate plant.
Yeah, I guess the question was related to that.
No, I mean, I understand that you have plans to do both or maybe a combination of both. So, just the query was regarding any, finalization of plans in this regard, whether the intermediate or the finished product.
No, intermediate so definitely we will make. Regarding finished product, we have not yet. I think it will take some more time to understand how the demand is actually going to grow in dicamba. So that we are evaluating. We have taken up in R&D and all that. So that product. So that decision for finished product has not yet been taken.
Okay. And on the intermediate, do we have customer visibility now, sir, in terms of market opportunity?
Yeah. There are possibilities for selling.
Okay, fine. Second thing was on the discretionary portfolio that you mentioned. So, can we interpret that roughly 40 to 50% of our spec chem sales, which is, auto and construction and all these are the products that were impacted in the quarter, and should we expect that this will improve now from 3Q onwards in terms of margins and pricing?
Yes. I think that's what was discussed earlier also, that going forward, the margins should improve quarter on quarter.
Okay. And the plants are still running at about 90%, you mentioned. So, which segment is still a drag, sir, on the overall utilization? Which end-use industries are it?
No, some of the products we are able to sell, but some products still remains, the capacity remains under utilized in some products.
Okay. And last thing from me, on the chlorination project, is it possible to quantify the amount of the project and how much was the fixed cost increase in this quarter because of that?
So the project CapEx was upwards of 200 crores. The specific number on the fixed cost, we don't have it right now. We have to circle back and share it with you later on.
No problem. So just to clarify, you said 400 crores, is it, Chetan bhai?
200 crores.
200 crores. Okay. Okay, great. Thank you so much. Wish you all the best.
Thank you, sir. We have next question from the line of Ranjit Sirumala from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. The one question in one of the answers you alluded that you would also looking to benefit from the PLI schemes in the pharma and probably the chemicals. Just wanted to get a sense whether you are looking at benefiting directly or it is benefiting indirectly.
There will be indirect benefits. And some of the API we are looking at whether we can develop.
So we would be taking 105 acres of land in Dahej. So is there any plans of taking a direct benefit, at least in the pharma side?
I think our pharma, basically the products which are there in PLI scheme are older products and they are more commoditized products. And we are more in higher value chemistry and higher tech chemistry where we do enzymatic reactions and we do anti-cancer, steroidal stuff. So I think, looking at the current list, we are not going to be in that space currently.
Okay, sir. Thank you. And the second one, we have been incurring upwards of 1,000 crores of capex, and we do guide it that it would continue to remain a bit elevated for at least next couple of years. So, is there a thinking within the company? Now we have these tax benefits, so we can easily set up a subsidiary and take the tax benefits. Is that thinking developed, or we will continue to do it in the standalone entity?
So there are a lot of hidden clauses in that tax benefit and other stuff. It's not an easy thing. So it is a effect which we are doing as of now. That would continue in the current tax structure.
And lastly, on the interest part, we have seen some 6 crore of gains, and that's why the interest cost is a bit lower this quarter. But if one way to assume a normal run rate, so if we add back 6 crores, so 28 crores should be the normal run rate of the interest for the next couple of quarters?
Yeah, it should largely be around that plus or minus 5-10% of stuff. I mean, it's all provided we look at the interest rate hovering around the current rate.
Thank you, sir.
Thank you. We have next question from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Yeah, thanks for the follow-up. So how much have we invested in the land, 105 acres?
Yeah, we have just not invested anything. We have just acquired the land. So the land cost, from a land cost perspective, I think we have invested close to 45 crores.
45 crores, 45, right?
45. Upwards of 45, I think, in 45 to 50.
So the number would be around 50 plus 50 crores.
Around 50, right? Yeah.
50 crores.
Okay, thank you. The second question is in terms of the cancelled long-term contract. So we are getting the compensation at 5 million per quarter. Now, if the company decides to get the material from us, then will that revenue be over and above this 5 million, or will it initially form part of the 5 million?
No, as of now, because they are not going to consume, they have stopped their construction. So, as of now, that issue is not there.
So at any point in time, if they again come back to us for material, it will be over and above the compensation amount. I mean, it will be a different revenue stream altogether.
No, that will have to be a separate, if it is outside this contract, then it will become a totally separate, there can be a totally new contract also, where the material may not be going to their own plant for tolling. So that is a totally separate idea.
Sure. Thanks a lot. Understood.
Thank you, sir. We have next question from the line of Pawas Petia from Inam Asset Management. Please go ahead.
Firstly, congrats on good recovery from 1Q. So when we talk about return to long-term trajectory of 15 to 20% PAT CAGR, so how does FY22 looks? Is it the base we take is FY20 and then grow 15 and 15 odd percent to 35%, or from a base of FY21, which is kind of flattish, we grow 15-20% every year?
So this is overall a 3-4 year period. So next year, obviously, we'll have a strong double-digit growth. The exact number, I think, in Q4, we'll be able to give better guidance for the FY22. And subsequently, there will be further growth in FY23.
Okay, sir. So over, say, next 4 years, the base we take as a FY20 or FY21, just because...
Yeah, FY20 will be the base.
Okay, sir. Thank you. Secondly, sir, in last few years, we have seen that we are in a capex mode, but the flip side is that our sales growth is kind of lacking whatever the capex we are incurring, and that's also kind of weighing on the return ratio, which used to be upwards of 20%, now is down to 15, 16 odd percent. So when this kind of reverses and we have a asset turn of more than 1x, and then again we are back to that high 20s return ratios.
Yeah, the turnover we'll see. Unfortunately, this COVID has given an impact here, and again, that contract also has an impact. But going forward, the top line will increase.
So the other way to ask is, what is the potential sales or EBITDA at constant prices for all the project capex we have incurred?
Yeah, the 2,000 crores plus top line is what we are looking at additional. From a side
X the two long-term projects you're talking, or that's included in this guidance?
No, that is included. Yeah.
Okay. Thank you. Thanks. That's all from my side.
Thank you, sir. We have next question from the line of Samir Dosani from Carnelian AMC. Please go ahead.
Thank you for taking my question. Just one clarification. What is the current mix of discretionary and other non-discretionary kind of thing? Because the FY20 was 60-40, right? Am I correct?
Yeah, FY20 was 60-40.
And what is the number for H1, sir?
The discretionary will be little lower than that.
Yeah. And the margins for discretionary are higher, I mean, or is it similar, or what is the margin trajectory for that, sir?
will be always product to product. So we don't have as a basket, we don't have any specific working.
Okay. Okay. I think that's it. Thank you.
Thank you, sir. We have next question from the line of Pratik Rangnekar from Credit Suisse. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Just a clarification on the specialty chemicals margin. So my understanding is that for the new business that you had to take in the non-regular markets, you had to match your prices with whatever was going in that market, because of which the spread on that contract is a little lower. But on the regular market discretionary products, your spread is still intact compared to what it was earlier. Is that understanding correct?
No, even regular market also there is a pressure. Obviously, I think because the demand is less. But non-regular market, the impact is going to be much higher than the regular market.
Okay. Okay, fair enough. Thank you. The next question is on the pharma margin. So in the context of your comment that there is a structural improvement in the margin. So can you just throw some more color on that as to what is driving that structural improvement? And if you could also highlight what is the ASP increase in dollar per ton or dollar per unit basis in the pharma segment?
Yeah, basically, as we are approaching towards fully utilizing our current capacity, we are concentrating more on the regulated and higher margin markets. So due to which the overall margins have shown improvement. And once the additional capacity gets onboarded, then there will be top line growth which will be faster and would eventually result in overall percentage growth in net EBIT number growth going forward. So we have API additional block coming in, and then also we have intermediate additional block which will get commissioned in this year and next year.
Okay. Is there a realization increase component here as well, which is contributing, or?
Yeah. Realization increase component is there. Yeah.
Is it possible to quantify that?
And more than 40-50 products are being made. 40 products of API we are making, and in intermediate space also we are making 50-60 products. So we can't quantify products. So overall there is an increase.
Okay. Thanks a lot. So just one more question on the dicamba plant. So you mentioned that you have visibility in terms of that there's a possibility in terms of clients that you can sell to, potential clients. So what would be your strategy? Will it be similar to the strategy that you adopted in 1Q, where in order to increase your volumes, you were willing to accept a lower margin there? So would you be willing to do a similar strategy in the dicamba plant as well? And in that sense, how fast do you think, or how soon do you think that you can fill up that capacity once it's commissioned, obviously?
Yeah, I think now the entire dynamics will change. So accordingly, we'll have to do the pricing for the product, and more volume for that will come in FY23. So FY22 still there's a pipeline dicamba there in the system. So some volume will come in FY22, and significant volume I think will come in FY23.
Fair enough. Thank you so much.
Thank you, sir. We have next question from the line of Prasenjit Via from Ambit Capital. Please go ahead. Your line is unmuted, sir. Please go and ask your question.
Hi, this is Rajendra from Ambit.
Please go ahead, sir.
Yeah, so I just wanted to check on one thing. When you say that, if I remember correctly, FY20 also there was some pressure because of nitric acid unavailability, and then AgChem and autos were weak. Global autos and AgChem were weak in FY20. And then FY21 we have seen a COVID impact. And in between, what I see is that in 19, 20, and 21, you would have actually done a capex of anywhere around 3,000 odd crores, and you're pretty much from 19 to 21, EBITDA would largely be flat. Even gross profits, for example, would have hardly seen a 3-4% sort of growth in between. So I just wanted to check with you. I mean, is it that the base business has also been under pressure over the last 2 years, given where we were in 19 realization? Probably have those realizations corrected and have also kind of put pressure on the P&L. And when you say that 15-20% growth guidance, I mean, I know you answered somebody in FY20 to be the baseline, but why not take it as 19? Because you would have also done a 3,000 odd crore capex since then.
Yeah, basically part of that capex will be also for your replacement capex as well as on sustainability related capex also. And now because of this order cancellation, the visibility will have some, what margins we are able to sell this product. As you know, in the previous question, that point was asked. So that also kind of puts one little bit of uncertainty on that part.
Understood, sir. And any comment on the specialty chemical? I mean, like for example, you had about 820 crores of EBIT in FY19, and probably will end the year at actually even much lower than what your FY19 number is. So I just want to get a sense on one is the capex that you commissioned, and that's causing some bit of challenges in the profitability. The other part is, of course, the base business or the base business that was listed there in FY19. Has it seen margin erosion over the last 2 years, and which ideally we should expect to recover in next 2 years?
Actually, more volume getting filled up also will give the additional benefits into that.
And any volume growth that you would have seen in your base business, let's say over the last 2 years, and 19 and let's say whatever the 21 number looks like?
Yeah. This year, this second quarter itself, we had gone substantially higher volume. Unfortunately, the margins were lower because of the situation. So once the situation normalizes, then that margin benefit will come in from that.
Got it. Understood. That's it, sir. Thank you so much.
Thank you. We have next question from the line of Falguni Sangvi from JP Morgan. Please go ahead.
Hi, sir. This is Sagar here. My question was again on the guidance for PAT. You mentioned that we have a flattish guidance for FY21. So I'm just doing a quick calculation. So this would mean that in the second half, we will do about 30% more business than the second half last year. So what will drive this business? Because as I gather, there will still be margin pressure, as it will sequentially improve, but not yet be at pre-COVID levels. So what will guide this growth in the second half compared to the second half last year?
Last year, Q4, that's about 10 days impact was there of the lockdown in the last year. And so overall, we expect the volume to grow and also the market spread also to get better. And pharma is also showing a good traction compared to the last year.
But all this will still have to give a 25-30% year-on-year growth. Is that so? In your mind, do you think this flattish guidance is still achievable, or it looks optimistic?
I think that is achievable. That's what in our internal budgeting we feel that this is possible.
Okay, all right. And lastly, for the cancelled long-term contract, so I understand that we have a second phase of commissioning which will happen by the end of this year. But in the first phase, are we keeping the capacity idle currently, or are we using it for something?
No, we are utilizing it for other markets
already.
Yes.
And what would be the utilization rate right now for that plant?
That is relatively less, but it should get ramped up from this quarter.
Okay. And it's related to developing the same intermediate which was going to happen.
And we have some flexibility also in the first phase. So we can make some other products also.
All right. And just one last question. Do we give any breakup of how much is the toluene a part of our business in the overall specialty chemical pie? Has it already reached, say, anywhere between 5 to 8% of the EBIT? Any color on that would be really helpful. The toluene part of our business, how much would that be of the overall specialty chemical pie right now?
Yeah, that actually this quarter the volumes were better, and going forward, we expect the toluene volumes to go further up in the second half as well as the next year.
But that business would be somewhere around 7 to 8% of our specialty chemical business already, or much lower? Like just a ballpark figure on that front.
I don't know. Chetan might have some numbers.
I would start hitting that kind of numbers.
Okay, already. Okay, thank you so much, and wish you all the happy Diwali.
Thank you. We have the last question from the line of Arun Prasad from Spark Capital. Please go ahead.
Yeah, thank you. My question is on the land parcel that you proposed to acquire. So if I recall correctly, on your QIP document, you said that you will be buying some land parcels in Gujarat. Is this done that same, or is it something incremental to that?
It's a different parcel.
So basically, we have parcel in land in Jagaria, and then we have this Vilayat Industrial Estate, and then over on top of that, we have this land parcel.
No, that Vilayat, this contract is still hanging.
Okay. Okay. And can you also throw some light on the breakup of the CWIP, that is capital work in progress, 1,500 crores in your balance sheet? Some rough breakup of what kind of projects is part of this?
I think this second phase of chlorination and second phase of first contract, the second contract, the NCB expansion also is going on, and pharma expansion, as Aarti mentioned, it is going to get commissioned in this next 2 to 3 quarters. So across the board, we'll see a substantial commissioning in second half and first half of the next year. Substantial capitalization will take place.
Right. And can you give some status on the NCB expansion also, sir?
Yeah, NCB expansion first phase towards the end of this year, and the second phase will happen in next year, FY22.
And utilization will also be right from the beginning. It will be higher, or how it is? Some guidance on that will be very helpful.
Yeah, I think utilization we don't see much issues there.
No, I'm saying now that you have around current capacity is there, on that you are doing 90%. So when the new NCB expansion comes, it will be maintained in 90%, or it will see some dip initially.
No, I think there is enough demand there, so we don't see any. Once the plant stabilizes, we should be able to run at full capacity.
Sir, do you have any further questions?
Sorry, actually, I couldn't hear some disturbance in the line. Can you please repeat, sir, on the utilization part?
Yeah, there is enough demand on that side because a lot of material is currently imported, so we'll be able to utilize immediately the increased capacity.
Thank you very much.
Thank you, sir. Ladies and gentlemen, that was the last question. I'd now like to hand the conference over to the management for closing comments. Over to you, sir.
It has been a pleasure interacting with you over the call. We thank you for taking time out and engaging with us today. We value your continued interest and support. If you have any further questions and would like to know more about the company, kindly reach our investor. Thank you.
Thank you very much, sir. Ladies and gentlemen, on behalf of Aarti Industries Limited, that concludes this conference call. Thank you for joining with us, and you may now disconnect your lines.